25% of the liabilities is eliminated, the net asset value is actually going to increase. And based on our calculation, we are projecting the discount to the NAV to be at about 40 to 50% once this transaction is successful. So it even provides further upside to you as an investor based on the objective that we're trying to achieve. Another thing to consider is the strong corporate governance of Dequity. Dequity has structured its board to reflect the requirements of the Jamaica Stock Exchange. But another key thing that I want to share with you is that even prior to going public, Dequity has always structured its board to reflect that of a listed company. As a matter of fact, as a private company, you were able to go on the website and see the management accounts and the audited financials, which is not something that is the norm for private companies in Jamaica. And then the final demerit for you to consider is the portfolio diversification opportunity. Dequity is giving the average Jamaican investor access to private equity as an investment asset class, which is not usually accessible for the average investor. These kind of investments are usually more reserved and accessible to high net worth and institutional investors. Here is your opportunity to benefit from an asset class that can give you astronomical returns. And with that said, I'll hand over to Kadeen to get into details about the company.
Thanks, Romario, and well said. So, afternoon again, everyone. So, my name is Kadeen Mears, and I'm the founder and CEO of Dequity Capital. So, just to give an overview of Dequity, it was founded in 2019, originally as a holding company for two portfolio companies that we had. We started M24 Investments about 12 years ago. The primary focus of that company was to offer services such as cambio, remittance, and loans. Over the years, we started to think about how we're going to diversify. Dollar was born, and the loan book in M24 was transferred into Dollar Financial, and that was the start of Dollar Financial's growth in terms of a lending company. We looked at the concentration risk that our holding company only had financial services businesses. So what we did was we continued to scale our lending business. We held on to a 25% stake, and we brought Dollar Financial public. That's where you'll see a lot of spike in our unrealized gains. Now, what that did for us is that Dollar gave us the opportunity now to leverage those shares so that we can use that funds to grow and to scale and to take on new companies that you will see now in our portfolio. What we've done with M24 is that we've kept M24 as a 100% owned subsidiary intentionally so that we can use M24 as a cash anchor business, because liquidity and cash flow is a big risk when you look at private equity companies. So we use this company to basically mitigate some of those risks. So over the years, what we've done is we've invested in different industries outside of financial services. So now we are in real estate, we're in healthcare, telemedicine, gaming, insurance, digital media, and print. So we were able to create a diverse portfolio of companies, and we were able to leverage the shares that we have in our listed entity that created the liability that Romario is speaking about, and we use that now to buy businesses, to grow these businesses, and to continue that trend that you see that we did with Dollar, where we grow these companies to a stage where they are ready and fit for a public offering as well. Outside of growth and scale and where we are, we've also evolved in terms of our corporate governance, and we've put in place a very diversified list of directors with different skill sets. One of our board directors is here, Dr. Damien Kane, who is actually our chairman of our board. Outside of Damien, we have Marcus Steele, who is a former executive for also a listed company. We have health experts, we have Dr. Jermaine Spencer, we have engineers, we have Dr. Garol Hamilton. We also have financial experts in the financial services space. On the next slide, we have Shade Mayer, who's also a director, and Suzette Neil Tomlinson, who's also an expert in financial services. So as you see, the corporate governance and structure was also implemented over the years to ensure that we're not just scaling, but we're prudent in our decision making. Outside of the board of directors, what's necessary and important for us are committees. As an investment company, the main committee for us of importance is our investment committee. all investments are looked at by management. Management recommends that and brings that to an investment committee. The investment committee then will bring that recommended to the board, and the board makes a final decision on every investment that is considered. Outside of our investment committee, we have our audit committee and our remuneration committee. Audit, which is chaired by Marcus Steele, and our remuneration, which is chaired by Dr. King. So about the executive team, outside of myself as the CEO, who's responsible for the day-to-day operations of the company, strategic oversight in terms of acquisitions and implementation of controls and scaling of our portfolio business, I of course have the support of our Chief Financial Officer, who is here with us today, Tiffany Taylor, with a background, who's a fully qualified member of the Chartered Certified Accountants, with a background from PwC. We also have our Chief Legal Officer, Mr. Victor Drum, who's also a partner at Base Legal Firm. A very important part of our business is HR. We have an HR executive, that's Ms. Shoshana Kogel. And what people have to realize is after we do an acquisition of a company and we go into that company, the back office is where we start. We look at what's the risk HR-wise, policies, procedures that are in place, accounting policies, any legal risk, you name it, as well as their corporate governance as well. So these are some of the objectives outside of just managing the day-to-day operation that the executive team has full oversight on. So looking at the shareholdings, as is right now, before listing, the current shareholding is as follows. As you can see, I'm at 85, and we have Dr. Jermaine Spencer, Dr. Guru Hamilton, and Evan and Teresa Nepal holding the remaining shares. And you can see the post-IPO holding, as there will be a 25% dilution of each of the current shareholders, and the public, which is you, would hold that 25% stake in the company. So now we move into the financial statements, and of course, Tiffany will take lead here.
All right, good afternoon, everyone. I'm Tiffany Taylor, the CFO for Dequity. So I'm gonna start by telling you how is it that Dequity earns their revenue. So we earn our revenue in three major ways. Firstly, through the remeasurement of our associates and subsidiaries, right? And this drives our net asset value. It drives the profit. However, it's non-cash until the investments are realized. So we can realize investments through either listing our portfolio companies through IPOs or through private sale. Secondly, we earn dividend income, which you know is pure cash. And thirdly, we earn revenue from interest income from our shareholder loans that we would have given to our portfolio companies. Now let's look at Dequity's performance over the past few years. All right, so we have remained profitable each year with different drivers at different times. So with dividend income, it generally has an upward trend up to 2023. In 2023, there was a spike in dividend income, and this is because one of our portfolio companies, M24, they had declared a dividend. In 2024, there was a decline in dividend income, and that's because there weren't any other dividend income from our other portfolio companies. And this is not something to be concerned about because our portfolio companies, they are in their growth phase, and while they're growing, they are focusing on a reinvestment, and as they mature, then dividends will be emphasized. As it relates to our profit, right, we had a sharp peak in our net profit in 2022, and this was largely as a result of an increase in the dollar share price in the market, right? In 2023 and 2024, the unrealized gains decreased, and there was a resulting decline in the net profit as well. But, based on our fair value model, the businesses, they are doing well, but with this model, the revaluation gains, they tend to come up very early, and then they normalize thereafter. They're just incremental adjustments. Now, if we look at our administrative expenses, there was a peak in 2024, and this was largely due to legal and professional fees because we had raised money through a bond, right? So those legal and professional fees, they increased, and management fees also increased. But these one-off expenses of the legal and professional fees, they ran off, and expenses begin to normalize. Post-offer, what we intend to see is that the interest expense will be gone. The plan is to retire the bond. It will decrease our interest expense, and therefore cash will become available. All right, so let's move on to our balance sheet. Now our assets grew over the 5 years, right? In 2020, our asset base was around US $448,000, and then in 2025, it grew to 27.1 million US. Right, and this growth was really driven by, we added new portfolio companies, the fair value remeasurements that we have on existing ones, and cash was redeployed into the portfolio companies. Right, as it relates to our liabilities, there was increase in liabilities over the 5 years as well. So in 2020, liabilities were at around 301,000 US, and then it raised to 6.17 million in 2025. But this is because, as I mentioned before, we did a bond, right? And as Romario mentioned, it represents 65% of our liabilities. So post-offer, again, we will eliminate this liability. We will retire the bond, and then we'll have more cash available. Now, as it relates to the cash flows, so over 2020 to 2024, there were negative operating cash flows over the course of the 5 years. Well, 4 out of 5 years, there were negative cash flows, right? But again, based on our business model, that's expected, right? Most of our gains, they're not going to show up as cash until we realize investment. Either we list our portfolio companies or we sell them. Our financing cash flows, however, during this period did increase, and that's deliberate because we either raise capital or we refinance existing capital, right? So again, this offer is just to increase our liquidity, give us more cash available to make further investments and for dividend distributions. So I'm gonna hand over back to Romario, who will take us through the valuation.
All right, thank you for that, Tiffany. And it's important for the public to just understand the business model of Dequity. Dequity is a private equity investment company. The primary purpose of Dequity is to really buy shares in private businesses and hopefully grow these businesses to a level where they're able to exit profitably. Therefore, in looking at this opportunity, we really need to understand that the revaluation gains, while it might not be cash, is an important indication of the value that Dequity is creating in these portfolio companies. Another thing to consider is the fact that dividend income cannot be expected to be consistent based on the type of private equity investments that Dequity is currently focusing on, which is companies in what we call the growth equity spectrum of the private equity landscape. And those are SMEs that are in their growth stages where they need a capital injection to really take them to the next level. However, they need to also preserve their capital so they're not in a position to pay consistent dividends. And it wouldn't be prudent to you as an investor to expect them to actually pay dividends to Dequity. Otherwise, that will actually hinder their growth and development. Another thing to consider is that when you're looking at Dequity Capital Management, you have to look at it from an asset-based valuation approach. A DCF wouldn't be the ideal approach to value a company like this based on the fact that you're investing in a portfolio of equity. And I'm giving you this context as a step into the valuation. So from a valuation standpoint, Dequity is valued at about $2.63 billion, right? And the offer is coming at $1 per share. This represents a price-to-book ratio of 0.78 times and a 22% discount to the company's net asset value. Now, when you compare this price-to-book ratio to listed equity funds on the JSE, it is below the average. The average is about 0.82 or 0.81 times. And we're talking about companies like Sagicor Select Funds Financial Services, Sagicor Select Funds Manufacturing, QWI Investments, MJE, Mayberry Jamaican Equities, and Portland JSX. So those are the companies that you really should be comparing Dequity to. And from a market-based standpoint, the price-to-book ratio is actually below the average of the price to book of these companies. In addition to that, we are coming to market at a 22% discount, so we're offering a value. In addition to that, once the company eliminates the debt from the balance sheet, about 65% of the liabilities will be gone, which means that the net asset value is going to be higher. And based on our calculations, that discount could actually trend upward to about 40 to 50%. So this also presents further upside potential to you as an investor if you should invest in Dequity. Another thing that we need to consider is the upside potential from the portfolio companies. So while Dequity might not be in a position to pay dividends now, the successful liquidation of these portfolio companies is when the cash flow is expected to come in. And when they successfully liquidate, that's when you as an investor have the chance of benefiting from dividend inflow. I believe I've actually gone through in detail the valuation. And with that said, I'll now hand over to Kadeem to discuss the key risk and mitigants. And as you know, with every investment, there are risks. But because we are prudent and we are responsible, we are here to discuss these risks upfront and to also discuss the mitigants to these risks. And I'll hand over to Kadeem.
Thanks, Romario. And to Romario's point, we have to remember that in private equity, these risks are not unique to Dequity on its own. They're unique to all private equity companies. And one of the first risks that we look at is the illiquidity of investments. So what we have to realize is that when Dequity buys a company and that company is private, that share or that block of shares that we invest in a private company becomes illiquid because there's no active secondary market to trade those shares on as a private company. Compared to when you buy shares in a public company, you can easily sell those shares on a stock on an exchange. What happens with private investments is we have to hold those shares in those private companies until we are able to position them to go to market, to go to market on the public market where those shares become liquid. Similar to how we brought dollar to the market, those were private shares, now they're public. So now those shares become liquid shares on the market. So that's actually one of the mitigants that we put in place, and that is to position all the private companies in a way that they are geared towards an initial public offering in the future. And what's important for us is to have an alignment with the entrepreneurs running these companies that their dreams and goals are also to bring this company to the market. One of the other mitigants that we put in place for this illiquidity risk is that we basically we'll keep our ear close to the ground in terms of the secondary market, which is the private market. In the event that a company doesn't show the potential to list, what we might look at is secondary markets, other companies that might strategically find our private entity attractive for them, and they might want to acquire that business and put it into their ecosystem. So we look at IPO one in terms of a mitigant, and we also look at the secondary or private market as a mitigant, and we put steps in place to ensure that we have enough controls as shareholders based on our shareholder agreements to influence these decisions when time comes for us to liquidate any investment. So that's one of the risks. A second risk, and Romario emphasized this one a lot, is valuation. So the valuation is a risk, but not in the sense of Dequity's valuation, but the fact that Dequity, through its business model, values each of its portfolio companies, right? And the fact is, we might buy a private entity for $5, and we use a third party to do a valuation, and they value that company at $8. But when we go to the market, if we had to go to the market to sell that company, we might not be able to get the price that we originally wanted on the open market. So that creates a valuation risk. So what we do to mitigate these risks is, one, we have our internal team that does valuations, and these go to our audit committee as well. Secondly, and most importantly, like we've done in the past, we have third parties, for example, like EY, for example, that will come in and do a valuation on each of these companies. And what we do to be safe is use a conservative valuation. We use a conservative valuation, and that is a value that is placed on these companies, and that is reflected on our balance sheet. So that valuation risk does exist, but we do put steps in place to ensure that these are mitigated. A third risk is portfolio concentration risk. And if you guys remember when I was talking about Dequity in the beginning, we had 2 portfolio companies, and these companies were financial service businesses. One was a lending, and one was a cambio and remittance, and that in essence was a direct exposure to portfolio concentration risk, where all our risk is to one industry. So what we've done to mitigate that over the years is we've increased our holdings, not just by percentage, but by the number of industries that we are exposed to. Currently, you might notice that our investment in financial services is significant, and that is because we were able to bring one of our portfolio companies to the market, and based on the share value of that portfolio company, just based on valuation, it would take up a significant part of our portfolio. But in terms of diversification of our other portfolio companies, you will notice that now we are in different segments or different industries, including the real estate, including the insurance brokerage business, including media and print, and we can go on and on. So our intention through diversification is to eliminate this portfolio concentration risk, and these are some of the mitigants that we highlighted here on screen. All right, another risk that exists, and Tiffany touched on this a couple of times, is the negative operating cash flow trend. And this is where most of the money most of the cash that we have is coming out of the business and not coming into the business. So what you find in terms of mitigants is that we ensure that we have companies that are able to pay dividends that brings in cash flow. We also get cash flow, as Tiffany said, from interest income from portfolio companies. Now, in terms of dividends, as Romario said, when you're growing a portfolio company, you can't expect to pressure a portfolio company into paying dividends, especially when they're in their growth phase. So what we've done in terms of a mitigant is that we have kept back our cash anchor business, which is M24 Investments, which is a wholly owned subsidiary, which when we determine that company pays us a dividend and give us cash inflows that's necessary, when we find necessary. So we use that as a mitigant by itself. Now, the biggest mitigant to negative cash flow trend, of course, is an IPO. Once we're able to grow a business, which we have some companies now that are on the verge, or we see the potential, or they have the necessary earnings and the corporate governance in place and reporting trends, these companies will provide us with positive cash flow and significant liquidity in the event that we bring them to market. So through IPO, just like when we IPO Dollar, those private shares become now liquid assets. So at any point, with our shares in Dollar, for example, there is 500,000 units at $2.50, for example. That's 1.2 billion in liquid assets. In the event that we need to diversify, we see an opportunity that we need to buy a company that's on a good deal that fits into our mandate and our portfolio. We can also liquidate from liquid assets shares to do those purchases. So we do have mitigants in place for this risk of negative operating cash flow trend.
Thank you for that, Kadeen. And I just want to also just give, for the average investor who might not understand some of these terminologies, I just want to give just a brief definition. So for instance, you would have heard me mention net asset value. And some of you might be wondering, what is net asset value? So net asset value is a metric that investors use to determine whether or not a fund is fairly valued. And what that entails is basically the assets. So if you look at the balance sheet of a company, you have total assets, you have liabilities, and you have shareholders' equity. In order to get to net asset value, what you simply do is take the assets and you subtract the liabilities, and that gives you the net asset value, which is basically the same thing as a shareholders' equity. What you then do after that is that you take that figure, which is the net asset value, and you divide it by the number of shares outstanding, and that will give you the net asset value per share. And that's how you compare whether or not it's a fairly valued transaction. So you look at the offer price, right, which is $1, and then based on the calculation, you'll see the net asset value per share. You hear me mention price to book ratio. That's basically looking at the price that's being offered, which is the $1 per share, and dividing that by the book value per share. So what is the book value per share? The book value per share is the shareholders' equity. Same thing as the net asset value. And And basically, you divide that book value or shareholders' equity by the number of shares outstanding to get the book value per share. And then you divide the price per share to the book value per share to get the price to book. And investors, when looking at investments from a market-based standpoint, they usually look at it from an asset base or earnings base. So typically, you will hear people make reference to PE ratio for normal companies or companies that are earnings based, but a company that is asset based. This is like essentially you're buying into a portfolio of private equity. And private equity is basically shares in private businesses. So it's similar to like you buying shares in companies that are listed on the JSE. The difference is that you're buying shares into private businesses. So essentially, it's similar to buying shares in a public company where the upside is you buy at a certain price and you exit at a higher price. So I just wanted to position that for the average investor who might not be familiar with these terminologies so that you understand the investment and you're in a position to make an informed decision. And with that said, I'll hand over to our chairman to kind of tell you why you need to consider this opportunity.
Thank you. This is an interesting opportunity for me because of where Jamaica is at this particular time. Everybody knows and appreciates that over the last 10 years or so, Jamaica has done a first-class and world-recognized job in fiscal management. You know, the government has brought down its public debt from 150% of GDP down now close to 60%. You know, we have low and stable inflation. We have relatively stable exchange rates compared to what it used to be for most of Jamaica's currency history. We see the infrastructure being built out. And so Jamaica now has, really for the first time since independence, a stable and predictable macroeconomic environment. And that means that there are a lot of opportunities for entrepreneurs. And when you examine the business landscape in Jamaica, there are thousands of small and medium-sized companies that new entrepreneurs are getting into and trying to build. And therein lies the opportunity, because the investment opportunities now exist, and there's a lot of entrepreneurial energy. And that is where Dequity is trying to fit in. We are trying to identify these small and medium-sized companies, take positions in them, and then to contribute by putting in capital, by assisting with the management. And so Dequity, as a private equity holding company, can take advantage of these investment opportunities in this new landscape. And by participating in this IPO, then you can take advantage of that too. And this is why I think this is such an exciting and interesting and new opportunity for investment.
Thank you for that, Chairman. And again, we just like to thank you for tuning to this investor briefing. We believe it's an exciting opportunity. We're giving average Jamaicans access to private equity, which, as I said before, is not an investment opportunity that is usually accessible to the average Jamaican, and that is the value that we are providing. I want to also just acknowledge the advisors to the offer. So VML Management is a lead arranger and broker, legal advisor, MF&G, and the Jamaica Central Securities and Depository Limited as trustee and registrar. And now we'll segue into our Q&A segment. So now we'll take questions from you as the investor. So this is Benford from YouTube. So for transparency, can you indicate if you currently hold or what has happened to your previous holdings in Kentire, formerly iCreate?
Okay, I think I can take that.
Yes.
We had made an investment in Kentire, formerly iCreate. That's a public company, as a public equity investment. Since then, we have sold down our shares in that entity. Not sure our current position, but it is not material enough to be considered as an associate or subsidiary of the company. So those shares were actually sold down.
All right, thank you for that, Kadeem. And the next question is also from YouTube. How does this company makes money? You want to take that?
Sure. All right. So as mentioned before, we make our money through three ways, right? We make gains on the value of our portfolio companies. However, these don't turn into cash until we sell a part of these companies, right? So we can realize gains through that way when we sell them. Two, through dividend income. So when our associates and our subsidiaries, they carry on their business, they make their money, they give us a portion in the form of dividends. And three, through interest income. So we loan some cash to some of our portfolio companies so that they can invest in their operations and grow. And then there's an interest rate on those loans, and so we will receive interest income through that.
If I can just well,
I'm going to add something to it, because we try to identify companies that are capital constrained. So the mere fact that we take an equity position in these companies removes that constraint, and that realizes their potential, and the value of the company grows just from our interest in them alone.
Yeah. I was just trying to give a practical example to that question as well, where we'll buy a 30% stake in a business, say it's a restaurant. We'll buy that stake in US dollars, say for on average 500,000 US. What we do is we go in, work with that restaurant owner to open more stores. We loan them some money. Now they have 10 stores. And what you find is that the value of our 500,000 now is 10x. So now our value in that company is worth 5 million US compared to the 500,000 that we originally invested. Now that this restaurant has become a big restaurant now, we can say to the people of the public, buy into this company through an IPO because it has a location in every parish. And that company goes public, and our shares are now realized as liquid shares on the market. So this company now starts paying dividends. So we're getting dividends, and we get the value that is created through those shares becoming public shares. So that's essentially how our business model works.
All right, thank you for that, Kadeen. And I just also want to add that a lot of companies that used to listed on the stock market, whether it be in Jamaica or overseas, they would have all started out getting private equity investment in some way or form. So this is actually a very popular asset class, and is also a primary source of wealth for a lot of investors. In addition to that, I also want to just kind of put some emphasis on the fact that Dequity, most of the portfolio companies in Dequity have been held for about 2 to 3 years. So there's still some more room for them to actually realize those returns. So they still have some time, because typically private equity investors would exit their positions within about 3 to 5 years, sometimes even longer depending on the objective. So the acquisition so far, Dequity has held them for an average of about 2 years. So they still have some time to actually realize returns from these investments. Another question from social media: when can investors expect dividend?
I think I'll take that one. And that's a common question. We know that investors love their dividends. But just like any other company that has a dividend policy in place, the dividend is always determined, or the board of directors, or chairman is here. The board of directors determine when is the right time to pay a dividend, whether dividend should be paid out to the shareholders, or if it's better spent on reinvesting in the company. So to answer the question in short, when will we pay a dividend? When this offer is successful, a lot of the cash that was being paid out to, I think it's around $80 million per year that was being used to service debt, this cash will now remain in the business. We also have cash that we're expecting to get to realize from portfolio companies who are performing as well. So compounded with our interest income, compounded with our dividends from portfolio companies, as well as cash that we can now reserve, when the time comes, the board will determine basically what do we do with the funds that we have on our balance sheet. Do we pay some out to the shareholders and invest? Do we do both, or do we do one? So that will be a decision that will be ultimately determined by the board of directors. But once we're performing, then we expect to give some of that value back to the shareholders through dividends.
But this doesn't tie the investor, because if the board determines that there are sufficiently enticing investment opportunities for us to retain earnings and invest in those opportunities, then the value of Dequity Capital is going to grow, and the individual investor can liquidate some of these now higher value shares and get a cash payout while retaining his original investment. So if we decide not to pay out dividends in any particular year, any investor can still take out some cash to be able to meet a need that they have.
Thank you for that, Chairman. And it's also important to note that based on the business model of Dequity, they have to be very prudent about how they pay out dividends, which is why the dividend policy is based on the free cash flows and not the net profit like other companies. Because as you can see, majority of the income is not cash, it's reval gains. It comes from dividend and interest income. So the company has to be very prudent. And as an investor, it's in your best interest for them to be prudent as well, so that they can actually take care of their day-to-day expenses. So while we know that dividend is an important component of the returns to an investor, the company still has to maintain some amount of discipline to ensure that they're able to maintain operations and support the portfolio company. So remember, it's 60% of the free cash flow of the company. However, when they successfully execute their mandate, which is what you as an investor would want, you want Dequity to successfully grow these businesses and liquidate their positions profitably so that that cash inflow can come in. And that is when you're more likely to see a dividend. That is what you should want as an investor, because that is how the company will be able to sustain its operations. And with that said, I'll just read another question. I have another question from social media. And that question is, what about management fees? Has it decreased?
I'll take that one. Management fees has not decreased, and that's because the better Dequity performs, the more management fees that will be expelled. And that's because management fees represent 2% of our asset value, right? And currently, it's a small percentage because on our books now, we have probably around 500,000 US in management fees, and the value of our assets is over 27 million US.
All right, thank you for that, Tiffany. And another question from social media is, how do you go about taking advantage of this opportunity? What is the process? So I think this is as it relates to applying for the transaction. So this is a strictly online application, and it's available on our VM Wealth IPO Edge platform. The process is simple. You can either apply as a guest, or or if not, you can create an account on the platform. And creating an account doesn't necessarily mean that you're creating an account with VM. It's just creating an account on the platform to facilitate the application. However, you can also apply as a guest. And I also want to position that you don't need to be a VMware client to apply on the IPO Edge platform. Anybody can apply on the IPO Edge platform. So it would pretty much just simply facilitating applications online. So just go to the VMware IPO Edge platform and follow the instructions, whether it is that you apply as a guest or you want to create an account and submit the application. Another question from Zoom. Currently, you have 9 companies in your portfolio. Are anyone coming to the market anytime soon? If yes, can we get a time frame? What is their performance like? That's the question. What is their performance like? Can we get a time frame, and what is their performance like?
So, of course, we can't say particularly what companies we're going to bring to the market, but what I can say is that it's in our business model. What we do is we buy companies, we build them up, and we get them ready to IPO. There are companies in our portfolio. If you look at some of the different industries that we invest in, there are companies or particular company that we think might be ready for a potential IPO in the near future. We can't say as yet, but yes, it is in our business model to bring these companies to the market.
All right, and we have another question from Zoom. How does Dequity ensure that it maintains a strong financial position and isn't over-leveraged with debt?
I think I can take that as well. I mean, if we look at our current financial position, our asset is about, I'll round it up to about 30 million in assets. And our debt is probably about, what, $6 million?
$6 million,
in
US dollars.
US dollars in debt. So I'll say our debt to equity currently, the percentage of debt to our assets is probably 30%, which is pretty a prudent way of managing debt. It has never been in our position to over leverage or put the company in a position where we're not in a position to service our debt or we are over leveraged. So I think we answered
Yeah,
that question?
yeah. So from a capital standpoint, the company is not necessarily highly leveraged. If you look at ratios like the debt to capital ratio and the debt to equity ratio, the challenge is that majority of the cash outflow is actually coming from debt servicing, and majority of the cash inflow comes from either dividend income or interest income. So because of that, that's the reason why we are doing this transaction. So how does the company preserve liquidity and balance sheet? We make timely decision that is actually going to accrue to the benefit of the company, and that is the reason why we decided to do this IPO. Because as I said before, the major source of the cash outflow for Dequity is really the finance cost, and that is what we're trying to get rid of. But from a balance sheet standpoint, the debt to equity, the debt to capital, and the debt to assets is not necessarily high from an industry standpoint. And then now we have another question. I'm scratching my head. Why launch an IPO now in this current post-storm environment?
I think I'll take that one, and that's a common question. I mean, of course, we would have been preparing for this IPO for months, over 6 months. It's a long process, dealing with the regulators and getting everything in place with our attorneys, our brokers, leading up to this point. We did have the decision, we did have the option whether or not to postpone this IPO, but we thought the best decision, I mean, as the Prime Minister said, is that, you know, we have to continue pushing productivity. We think that putting Dequity itself in a better position is actually good for our portfolio companies, some of which might have been affected by the storm as well. So we believe that us putting ourselves in a better position, we can then help our portfolio companies and also help Jamaica to rebuild at the same time. And in the same breath, I mean, I'm not good with Bible verses, but I think there's a verse that says, he that watcheth the wind will never sow. So, I mean, given the circumstances, I think it's still important for us to drive through. You know, we still have to invest. We still have to go and open our businesses. And the exchange will continue just the same.
All right, thank you for that response, Kadeen. And then we have another question from Zoom. Given that many of your portfolio companies are privately held SMEs and considering the use of IPO proceeds for both debt repayment and future investment, can you clearly explain how independent valuations will be verified, how frequently they will be updated, and what specific governance safeguards are in place to protect minority shareholders in situations where performance, transparency, or exit timelines do not align with projections?
Okay. Well, we spoke on, we kind of touched on this when we spoke on our transparency and our corporate governance and our committees. It's very important for us. If you notice, when it comes to reporting, based on our track record, when I was CEO of Dollar, one thing that we're big on is reporting. One thing we're big on is Big Four audit firms. We've always used like a Grant Thornton, who is our auditor here. We've also used for our portfolio companies like a PwC. When it comes to valuations, you can expect that every year a valuation will be done or continuously be done on our portfolio companies, and that this third party or this evaluator is definitely, I would say, a Big Four or a reputable valuation company that gives the arm's length between what we do internally and what our external third-party evaluators offer. And of course, these reports will be shown to the public and will be very transparent, as they currently are.
All right, thank you for that, Kadeen. And just to add as well, in taking these portfolio companies public, the decision around valuation will also involve the broker and the arranger that decides to take these companies public, and oftentimes that is done through internal, due diligence and consultation, as well as market reads, and based on where, the current market is at. So these valuations will be determined through a number of parties, as Kadim would have mentioned, third-party evaluators such as the Big Four auditing firms and the external brokerage houses to ensure that these transactions are priced for success.
Yeah, and if our business model is to build up the value of these companies and for us to realize the gains by IPOing, it really doesn't suit us to to fool ourselves about the asset value. We need to understand very clearly what is the value of these companies at all times, so we can make these decisions about when it's ready to IPO and when it's ready for reinvestment. So I think the motivations are aligned between ourselves and small investors.
Thank you for that, Chairman. These were some very insightful questions. We really appreciate you taking the time out to, listen to us and consider this investment opportunity. Again, on behalf of VML Management, we want to express our gratitude to you watching this investor briefing. Dequity Capital Management is also very appreciative. And I just want to close by saying that this is an excellent investment opportunity. It's giving you access to, as I said before, an asset class that's not traditionally available to the average investor. It's attractively priced. And now is the time to take advantage of businesses that are primed for success.
Romario, I think just to add to your point, I think it's important to probably tell the viewers. We can tell the viewers, Romario. We can also take some more questions, but we can also tell the viewers exactly how they can apply online, given that this method is pretty new, I would say. Persons are used to going into their broker location, into a branch to apply. So it's important for us to go through the process, I guess, take some more questions and let them know that they can access it on the VM Wealth Edge platform.
All right, no problem. So we'll see some more questions on YouTube that we're going to take. This one is, how do you go about identifying businesses to invest in, approaching their owners, and is there any industry or sector you're looking to expand into?
That's a question that we get all the time. How do we scout, or how do we identify potentially new investments? So one, we're always looking at what's happening in the market. We look at companies who position their brands well. We look at entrepreneurs who are who show perseverance, who are pushing their brand, who have that resilience that is necessary to build and scale a business. And what we'll always do is we'll reach out as well if we see a business that might fit into our portfolio. We also have businesses that will reach out to us directly through email or through other methods, through social networking and such. So that's the way that we kind of scout to find new companies. And there was another part to that question.
Yeah, I can assist you. So another thing that they focus on Dequity is that they are more interested in companies that are considered growth equity. So companies that show consistent growth in revenues or EBITDA, but they just need additional capital to really take them to the next level. So they don't invest in startups or ventures or VCs.
Right.
It's companies that are fairly established, but they just need capital injection in the form of equity to take them to the next level. And Dr. King is about to add another point.
So we are trying to leverage the entrepreneurial interest and effort of the founder of the company, not to take over the company. And once we can identify that business that is growing and that the founder is interested in continuing in, but as Romario points out, he's constrained by not having enough capital, and perhaps also constrained by not having the full breadth of managerial, technical ability and knowledge to be able to scale it up. And then we bring that in.
Correct.
And so that is where the growth is going to come from.
And the corporate governance as well.
Oh, definitely the corporate governance.
So Dequity knows what it takes to become a publicly listed company. They have the corporate governance framework in place, and one of the essential things that needs to be established for private businesses is that corporate governance framework needs to be developed, because oftentimes a lot of SMEs or private businesses, they don't really understand, corporate governance requirements. So, it's essential for them to get that advice through private equity investors. Another question from Zoom is, can you speak about the lawsuit regarding former Dequity fund manager and CEO Adrian Smith and potential implications for stakeholders?
I think Sheer will take that one.
Well, first of all, there was a former CEO of Dequity Fund Managers who, upon his resignation from the company, decided to come back and ask for the contract that he had signed and had voluntarily resigned from to take issue with the circumstances. The first thing to understand is that is a different company. That is Dequity Fund Managers, which is the management company, which is privately owned. This IPO is Dequity Capital. And so the implications for Dequity Capital are completely, are non-existent. That issue, which so far has not found merit, is being discussed and is being dealt with by Dequity Fund Managers.
Thank you for that, Chairman. And we have another question on social media. Apart from finance, will you be involved or be influential in decision making by the owners of these private businesses? If so, how will you have people on their boards, for example?
Okay. Well, if I interpret that question properly, I'll try to answer as best as I can. After having conversations with our principal, owner, entrepreneur about investing in their business, the next step is they get their lawyers and we get our lawyers and we come to the table. And one of the things that we ensure that we put in place is a shareholder agreement. And this shareholder agreement stipulates what the requirements are on Dequity's end, as well as what they require, as well as shareholders in the business. But what's important for us is to ensure that there are a couple standard things that are a part of our shareholder agreement, which includes board seats, seats on certain committees so that we have proper oversight, and also that we agree on certain projections or goals or milestones for the business. So that's how we take an active role in these companies from a legal standpoint. However, separately and apart, what we also have is we have a back office support. So one of the weaknesses that you'll notice with a lot of SMEs is their accounting or back office. So what Tiffany does with her team is that they'll go in and they'll look at the weaknesses and try to fix some of those problems, implement proper accounting policies, procedures, and ensure that these companies can report on time, because if you can't report on time, you can't be a listed company. These are some of the things that we look at, as well as HR-related things, as well as strategy in terms of sales, whether it's a product or a service that they're offering. We give that support as well. So combined with the management support, there are actually legal things that are enforced in the shareholder agreement to ensure that we are also protected as the investor.
Thank you for that, Kadeen. There's another question on social media. I agree with you regarding pushing productivity. However, I think the time frame is short for this IPO. Why not until the end of December to reach more investors?
Given what we have articulated here as the opportunity that exists, we just didn't anticipate that it would take until the end of December to get a full subscription.
And then also, I don't think December would necessarily change the situation significantly, because December is usually a time when people are focused on buying other, spending on other necessities, gifts, events. So actually, it's ideal to do an IPO before December from a market standpoint. It's a good question, but ideally, traditionally in capital markets, most companies want to do an IPO before the December period, which is when fund managers are busy, people are going off on vacation, investors are more prioritizing other necessities. Another question from social media is Dequity eyeing companies in sectors you're currently not in, or are you satisfied with your present portfolio?
I can take that one.
Sure.
Dequity is always looking at continuing to diversify its portfolio. There aren't any specific industries that we're looking at currently, but what I want to emphasize is that over the last 3 to 5 years, Dequity was in a buying phase. We borrowed money, and what we did was we went out and we went into insurance, we went into real estate, we went into print and media. We were in a buying phase, and we built these companies, and we continue to grow these companies. So what we're looking to do now is we're looking at partial exits through an IPO or bringing these companies to the market so they can continue to grow. So what you'll find is that we'll be less on the buying side and more on the selling side, for want of a better word. So what you'll find is that if we acquire one or two, if we want to list at least 1 to 2 companies per year, and probably acquire minimum 2 to 4 companies, new companies each year. Not specific to any one industry, but diversification is key. And even given the circumstances surrounding everything that happened with Melissa, diversification is important. Portfolio concentration risk is a real thing. And one of the strengths for Dequity, a practical example, is even though we might have got hit on the financial side based on a portfolio company, on the healthcare side with our private hospitals, there's been an uptick because the public system is down, for example. That's how diversification works, and that's one of the big benefits that you have when you invest in a company like Dequity, a company that is able to be resilient in good and bad times, whether it's macro, whether it is a hurricane, whether it's a war that's happening. Diversification is key, and that's a big strength that Dequity offers.
Thank you for that response, Kadeen. Another question from social media is, given that Dequity's model focuses exclusively on scaling existing portfolio companies rather than building new ones, how do you plan to ensure long-term diversification and resilience across economic cycles, and what mechanisms are in place to prevent strategic stagnation or current over-concentration in current portfolio sectors?
Because it's our, as just articulated by Kadina, it's our explicit goal to diversify across sectors and to identify new companies and new opportunities. So, once we keep our eyes on ensuring we have the cash flow, that this energy is always going to show up in new acquisitions and further diversification.
Thank you.
So I don't think there's any stagnation risk at all.
Yeah. And the company will continue to focus on sectors that show potential and have the high potential to growth. I think one of the strategy behind the acquisitions are looking in sectors that are positioned for long-term growth, where the expectation is that there will be significant demand for whatever product or services these companies provide. So for instance, healthcare, if Dequity is able to list Royal Winchester Medical in a short period of time, that will be the first hospital to be listed on the JSE. And we all know that healthcare is a consumer staple. People will always need to go to the doctor, whether it be for checkups. People will always get ill. And then also outside of that, outside of that, which might be viewed as a negative perspective, people are actually becoming more proactive about their health. Exactly. So you have persons who are now taking more, advanced measures to ensure that they remain healthy. So there's also an uptick for healthcare services from that angle. So the company tries to prioritize focusing on investing in sectors that they see is positioned for long-term growth, and also trying to achieve synergies between the portfolio companies. For instance, there's a potential synergy between Royal and
MD Link.
MD Link. Yeah.
So just to touch on some of the industries that we're in, telemedicine, that's where MD Link falls in. Sometimes the synergies fall within our group, as you said. So we're in healthcare, we're in telemedicine. Probably it's in the best interest of the group that both companies be more strategic in their approach. So we're also in gaming. We're also in real estate. We just completed our first development as 54 apartments, and we're looking to continue to develop new spaces as well. We're in the insurance space through an insurance brokerage that we acquired. We're in the financial services space, as noted. We're in the print and media with Elite Concept and Solutions, which is big in the western side of Jamaica, expecting an uptick in terms of their demand for their services, given to the unfortunate Hurricane Melissa that took place. So we continue to stay diversified, and all these industries give us that strength.
All right, thank you for that, Kadeen. And with that said, we are going to take a short break to allow you to learn how to apply for this transaction. Please watch the following video.
Investment vehicles are not created equal. Some are built for speed, others for safety. But high performance, that takes intelligence, precision, strategy, purpose. With BMW, wealth management, your money moves forward. Not aimlessly, not recklessly, but with intention. Whether you're just starting out, accelerating toward a goal, or steering in professionally managed, driven by performance. Put your money in motion. VM Wealth Management.
We took a short break. I hope that video would have helped you significantly in how to navigate our IPO application platform. So we have another question. We'll go straight back into the Q&A segment, and there's a question from Israel Ellington on YouTube. The question is, can you speak to the spread of sectors or segments the company is currently exposed to? So I'll hand over to Kadim to answer that.
I think we passed
Kinda
over
touched
this
on
in the presentation.
But reiterate.
I can reiterate that majority, I'd say under 50% are, and I don't remember our financial services exposure, but it would be significant because we have a publicly listed exposure that significantly boosts that, along with our Cambia and remittance business as well. The other significant industry right behind that would be real estate, because of the magnitude of our real estate development and the value that creates on the balance sheet. And that's followed by our healthcare space, which we own 2 private facilities, one Winchester Surgical and Medical in Kingston and Royal Medical in Sablamore. So I think those are top industries that have, in terms of spread and percentage of in terms of our portfolio currently.
All right, thank you for that, Kadeen. Another question is also, are you at liberty to speculate on the company's ability to take position itself in PLCs? I'm going to assume that refers to publicly listed companies, given the effect. Could you just scroll down, please? Given the effect of Hurricane Melissa on the equity market.
I think I can take that one as well. I think our mandate is clear. What we like to do is, if we have a clear mandate, our business philosophy, our investment policy, which clearly states that, we are going to buy SMEs, private companies, we're going to build them and go to the market. We kind of stick to that mandate unless the board sees fit, where there are opportunities that in the public market that could boost our performance. But as is, wouldn't be able to speculate, and that's not in our mandate currently in terms of seeking out publicly traded companies to acquire shares in.
So there are 2 circumstances under which we are going to end up owning shares in publicly traded companies. First one is, if we IPO a company, we might determine that it's not prudent to liquidate our entire position immediately, because we want to time that so that we get the best value. So we're going to end up, for a time at least, owning shares in companies that we have IPO'd. Secondly, from a short-term cash management point of view, it might suit us to take a position in a publicly traded company for a time, but not really as part of our overall investment portfolio. Yes?
Yes, indeed. So again, it's a private equity firm, so investing in public companies will be a deviation from the company's investment mandate.
Correct.
There are other companies on the stock market that do that.
Exactly. Yeah.
That's not us. That's not our space.
Correct. Because there are quite a few companies on the JSE that buy public equities, that are equity funds focused on public equities. Dequity is not one of them. Private equity. The next question is: are the treasury notes likely to be released to manage inflation in the near future, be a part of what the company considers to add to its asset portfolio? So I guess you're asking if liquid investments such as like short-term treasuries and bonds, like fixed income securities, will be purchased.
Again, only as part of cash management on a short-term basis, but not as part of our investment portfolio strategy. Tiffany will decide that from time to time.
Yeah. Naturally, when a company has liquid cash, they'll use it to, they'll preserve the purchasing power of that cash. So that could be a possibility. And we have quite a few questions. However, we'll answer the rest of them online. We have reached the end of our session. So again, we want to thank you for joining us. We appreciate you giving us the support, and we really hope that we were able to adequately position this investment opportunity and address the key risk associated with this investment. As you know, every investment has risk. What matters is that we are able to mitigate against these risks. Again, thank you for tuning in on behalf of VM Wealth Management. We appreciate your audience. Have a good rest of evening.
And check for the links to sign up for the chat.
Thank you for that, Kadeen. And remember, apply for the transaction on the VM Wealth IPO Edge platform.
In the last 5 years, Dequity has grown from an early stage private equity company with less than $75 million in assets in 2020 to over $4 billion in 2024. Over the same period, our retained earnings have surged from just $7 million to nearly $3 billion. This trajectory proves our ability to scale and reinvest for the long-term value. Our portfolio now spans over 8 companies, including real estate, healthcare, financial services, insurance, and more. At Dequity, growth is not in our history, it's in our future. Join us as we continue building value for our investors and shaping the next generation of Caribbean enterprise.
Investment vehicles are not created equal. Some are built for speed, others for safety. But high performance, that takes intelligence, precision, strategy, purpose. With VM Wealth Management, your money moves forward, not aimlessly, not recklessly, but with intention. Whether you're just starting out, accelerating toward a goal, or steering into legacy. Professionally managed, driven by performance. Put your money in motion. VM Wealth Management. Transform your